Hello, welcome to the YouTube channel and subscribe if you haven't already. So I've been getting a lot of questions following my power of compounding video, where people ask, for example, if I started with an amount of X and then I contributed Y, how would that grow over the years? And what would be the interest per month or per year? So I want to expound on the power of compounding video, offer more clarity, and also offer more content. So the first thing obviously is the assumptions. So I'm assuming that we'll be earning a rate of 9% net of withholding tax and management fees. So this is actually the current Sanlam return. In October 2019, CIC is earning 9.37. So, so let's use 9.37 so that we don't confuse people watching this. Great. And then I will introduce the factor of age in just to show and to stress the point that the more time you invest, the better. And that's why when you're young, you need to start. You don't need to worry about the amount that you're starting with. It's more of the consistency of your investments. And then the other thing I need to say is obviously this net return is not constant, but I assume it's constant over the years. So for example, when I say over 30 years, I assume that this is the only rate. However, if this was to go up, then it means that number would go up. If it was to go down, then it would mean the number would go down. So just bear that in mind. And then the other thing is I do assume that the funds invested are allowed to compound over the period. That is, there are no withdrawals. You do not stop the compounding train. And then just to know the green cells. So in this table, the green cells represent the first time you'll earn your first million. Okay. Then the green cells in this table show you the first time your passive interest income earned from the money market fund will equal your monthly expenses. So for example, if I was to change that to 10,000, you'll see the number of greens have increased, and it means somebody who started with an investment of 5,000 and doesn't contributes, for example, that 5,000 after that, then in 4 years they would have 11,000 coming to them passively. And then if you want to see how much that 35,000 with an initial investment of 5,000 would be in 4 years, it would be 1.9 million. But we'll get deeper into this, so don't worry. And then obviously everybody keeps on asking for this compounding template. I know it's valuable, but my view is I'll send this free customized PDF report on how your funds will grow based on an initial amount of X and monthly contribution of Y invested at a rate of Z. This can help you, when you're making your decisions, because as I say, money markets are not the only way to compound. Whereas this worksheet assumes monthly compounding. For example, you can invest in the stocks, but then you'd be doing yearly compounding and so on and so forth. And this can be manipulated for these circumstances. It does help you to find out if a certain investment makes sense, because you can be able to project the performance over the number of years you want, and it's highly customizable. So I can put 71 years, what will be the number then, kind of thing. Okay, cool. What else? Yeah, but as I was saying, for now, if you meet the criteria of number one, you're subscribed to this YouTube channel, and number two, you've opened a money market account via my signed forms, then what I'll do is extract a PDF based on what your planned monthly contributions are and your investment, and I'll send that to you. However, if one day I open my YouTube channel and there are over 1,000 people who've subscribed to it, then I'll just share this on my website in a way that anybody can edit freely. Great. So the first question, or the first thing that I want to show, is how compounding works. and I'm going to remove the filter here so that I can break it down. So for example, and let's play with a bigger number. Let's say somebody started with 1 million. 1 million, sorry, 1 million, and they are not contributing anything, they are contributing 1,000 and so on and so forth. Let's see how compounding works. So the money market funds that I recommend is Sanlam and CIC, and both of them you'll earn a daily interest, but then it's compounded on a monthly basis. So for example, if we assume you're starting at the beginning of the year and we invested at the rate of 9.37 and the current CIC rate, let's just assume you're back in January, then you'll earn an interest of basically that 9.37 adjusted for withholding tax, then divided by the number of days, which is 365. And that gives you a daily interest of 218 bob, which might sound like a small amount, but then it accumulates over the month, the year, and the years. So for example, in the first month, in February, what happens is you started with 1 million, so there's no compounding during the course of the month, but then at the end of the month, what they do is they come and say that 1 million plus all the interest that you earned during the month, and then that amount is what is used to compute your daily interest now in February, for example. So, and then obviously your interest for the month would be your initial 1 million that you started with, and then you subtract the end amount that was credited to your account. So uh, maybe just to pause a little bit and say that the way it works with money market funds is, for example, if you want, you can withdraw your money anytime. So let's say you're earning your money up to day 11, and then you decide, oh, I have an emergency and I have to withdraw this. So they would actually pay you 1,240,000, which is basically the accumulated interest plus your 1 million. So that's something that most people don't know. You can withdraw anytime without any penalty, unlike something like a um, fixed deposit where you'd actually forfeit this interest. So if we go back to the monthly example of 6,764, if you are to withdraw at this point and this was a 2-year, or let's even say a 2-month fixed deposit, then you'd forfeit that 6,000, which you won't with money market funds, and that's what makes them great. So, but back to the example. So now you can see that in February you're earning a little bit much more daily, and this is because now you're earning interest on this 6,764, and that's how the power of compounding works. It's interest earning on interest earning on interest, and this is how money starts working for you and you start earning money passively. So the more this number increases, the more money is working for you. And then, for example, in my situation, it's 1,000 with 0 contributions. So if you start contributing, then you accelerate the power of compounding, because then if you add 1,000, so for example here, if you add the 1,000, then that 1,000 every month works together with the interest that was earned in the previous month of 6,000, and that's why at the end of the day, somebody contributing 0, both of you started with 1 million, they will end up with almost 1.1 million, when you end up with 1,082,000, they will be at 1,095,000. So you can see, and that is just because of the small impact of 1,000. Obviously this goes up the more you contribute. So you can see somebody who contributes 9,000, a difference of 8k between these two people, but now they have 194,000 more compared to this person who has 95,000. Okay, and the contributions, and we'll see that the contributions also impact your interest earned. So somebody who puts in 1 million and then doesn't touch it, this is how it will grow. This is how the income will grow over the years. But then you can see if you add just 1,000 to your million and you just contribute 1,000 and you don't introduce any more investments after this, you can see the difference between somebody who's not contributing, let's say after 45 years, would be this person would have 653,000 income coming passively per month, which is a big amount, but it shows you the power of compounding. So you can literally live a very lavish life with this kind of money. So you're lucky if you have 1 million and you just want to live off of it. Cool. But yeah, you can see 653,000, whereas somebody who's contributing 5,000 is late late years away. Okay. But then let's go back to this example. So the principle is uh, that this 6,000 will start earning interests over and above your 1 million, and that's why this number has gone up. So again, in February, now we would compound at this rate, and then obviously I'm assuming that the rate doesn't change during the year, which it does. So that's why these numbers are not cast in stone. So for example, if this rate goes up to 10%, then it means in this month you'll earn even more interest just because the interest rate increased. Yeah. So as you can see, same principle at the end of, and you can see the amount here is lower, but it's because February has 28 days, whereas January has 31 days. But actually, if you compare two 31-day months, so for example, March, um, compared with January, you can see March is higher. March is higher because then obviously March benefits from the compounding impact of that 6,000 and this 6,000. Okay, but that's how compounding works. So obviously, who has time to do this kind of big formulas? Me. But then I had a shortcut. So the shortcut is, if you look at these, uh, it's a formula encoded to do basically what was happening here automatically. So what it does is, for example, at the end of the year, of this year, and maybe to make it easier, I'll just show you the monthly amounts. So if, for example, you were to take the monthly amounts for the full year of January to December 2019, you'd end up at a total of 82,617, which is this amount there, 82,617. So, and then if you wanted to find out how I got my 6885 from this exercise, you can still see that if you take the average of all these, it will give you 6885. So what you need to know is that these numbers, they are average indicative numbers, but as you can see, during that year, I ended up earning up to 7,800 towards the end of December, whereas I started with 67, 64. Okay, let's see what next. So as I said, money market funds are not the only way to invest, but what I like about them is that they give you this automatic compounding. So for example, if you invest in the stock exchange, like I have a dividend stock that was earning, that earned more than this 8% net of everything. I think it earned 12.75. So obviously that is higher, but then the only problem here is, number one, for me to take advantage of the power of compounding, I would have to take that dividend that I earned and buy the stock again. So obviously when you're buying the stock again, first you incur transaction charges, so like the 2.1% that is charged every time you buy or sell in the Nairobi Stock Exchange. You've not even put your bank charges, etc. And that's the only way I would be able to compound. Now, in a money market fund and actually in all unit trust funds, they do this for you. So that actually makes them even more valuable. Same with the treasury bill. If it matures, then you have to again purchase another bill with the money that you earned. And what stops you from, for example, spending that money? So what I like about money market funds, especially if you're not disciplined enough to do manual compounding, then what I would advise is just agree on what is the monthly amount that you want, and then just tell the money market fund or Sanlam, in this case Sanlam or CIC, to reinvest your amounts so that you just leave compounding to work and grow to these amounts. Cool. Then the next thing will be the fact that money market funds, and that's why I use them as my beginner investment lesson. So I'll obviously go deeper into other asset classes, circles, the Nairobi Stock Exchange, Global Index Fund, real estate, and so on and so forth. And I'll give my tips and on how to do them, and I'll try break it down into how a beginner, total beginner, can invest in those asset classes. The reason I started with money market fund, it's just there are numerous advantages. So, for example, I spoke about automatic compounding. They're also low risk investment vehicles. So, that means it's very hard to lose your investment. However, when you increase the risk, for example, in the stock exchange, this 1 million, you can lose it because for example, if you buy a stock and then it goes down, then it means you lose your capital. So if you sell the stock. So that's why I wanted to start with money market funds, because I feel it's a low hanging fruit. Anybody can do it. The other good thing about them is they are affordable to any person, especially young people who can take advantage of the power of time. So for example, let's say you're 20 years old, you're just joining university or something, and your parents give you 5,000 so that you can put into the CIC. That's the minimum for CIC. For Sanlam is 2,500. So you can even use Sanlam amount to just show the minimum that you can start with. So if you have the foresight, and now you have it because you're watching this video, to invest this 2,500, and we are assuming that you never even invest something else. This is your initial investment over the period. But then you decide every month I'll be contributing 1,000. So let's see how this plays out. If you contribute 1,000 and you started with 2,500, in the first year you will have 15,000, whereas somebody who didn't contribute anything would have that 2,700. So you can already see the difference of their 1,000. Then what I normally see with people is they get discouraged with these small amounts. But what you need to know about compounding is it starts very slowly and then it builds up. And the reason it builds up is because these incomes that you're earning, they start earning income, as I said in the beginning. So money starts earning money. It starts as a penny, that penny starts working for you, then they become 2 pennies, 3 pennies, and so on and so forth. And that's why you can see, for example, somebody who's contributing 1,000, in the first year they'll get 55 bob, okay, per month. uh, but then what happens when they get to 50 years? They'll be earning 44,000 per month. You can imagine how much you can do with 44,000 just coming to you passively. You can pay your rent and deal with a lot of household expenses. So that's why I encourage people to not think about the amount, because people think that with investing you need, for example, 100,000. Okay, and we'll compare the two. We'll compare somebody who starts with 100, doesn't contribute anything. 100,000 doesn't contribute anything. So I want you to pay attention before I do that to the amount after 50 years, which is 44,000 income per month that comes to you passively. And then with their 1,000, after 50 years, the person will have 1.5 million. Okay. So let's play around and put a big figure. So let's say, remember when I was in university, my help was the maximum you would get is 65,000. So let's say somebody who has 80,000 when they are 20 years old, they have money. So what's the impact of somebody who has 80,000, doesn't contribute anything? In at age 50, they'll have 865,000. Remember the person who started with 2,500 but was contributing 1,000 per month, ended up at 1.5 million. Then let's look at the income that they will be earning. So they'll be earning 23,000. The other person was earning 47,000. So you can see, never be scared to start investing. What Because you don't have a million. It also happens with businesses. People think that to start a business you need to have a million. But sometimes actually from experience and the books I read, it's more of bootstrapping. You start with your 3,000 business and grow it from there, and you'll end up having the right controls and the right people, rather than you getting 400,000 to start a business and then you start buying office chairs, etc. Before you know it, you've actually exhausted your capital. But I digress. So I can just go back just to show people. As you can see, 2,500 with 1,000 contributions per month consistently contributed, and compounding has not been impacted. Remember the assumptions that I said, and obviously also the rate almost remains the same. They will end up better off than somebody who started with 80,000. Somebody who started with almost 800 times the amount. So I hope that motivates people who think that investment is only for people who have small amounts. So the next thing that I need to look at is, so the next thing you want to consider is also your age. So the younger you start investing, the more time you have to compound. So you can see in my example, somebody who starts with 1,000 with 2,500 will end up at age let's say age 65, the retirement age. So you had the foresight to start your investing early, you'd end up with 3.5 million. Let's see how a 30-year-old would fare with the same amount. So I just need to change that to 30. And then for them, their retirement age will be there. 35. They have 35 years to compound. You had 45 years to compound. And they invested the same amount of 2,500. So they'll end up at 2.3 million, while you at the same age, if you started when you are 20, would have ended up with 3.5. So you can see the impact of 10 years more of compounding. For the person to catch up, they would have to contribute way much more than the person who started with 2,500 and 1,000. So for example, let's see where they would fall. So, and that's why I like this template of mine. So I can come here and say 5,000 to play around with the investments, and the target amount is 3.5. We just want to see when they will end up there. Okay, cool. So if I look at this and then I need to make this age 30. So it looks like for them to end up at, for example, somewhere close to 3.5, they would have to be contributing 15,000 and start with 55,000 for them to catch up with the person who started with 2,500 and 1,000. So what I tell people is start now. Even if you're 30, the implications of getting to the same amount when you're 40 will mean that you need to fork out more money than somebody who started at 30. And it goes down to the day level. If you don't start today, if you start today and somebody else starts a month later or tomorrow, you'll end up compounding for a longer period. So that's very important. Then the other thing, so I've talked about the importance of the rate. I've talked about the importance of the time that you compound your investments. I've talked about, I wanted to also talk about this. So also my template, what I do is you want to, at some point, for you to get financial freedom, you need to get to a point where your monthly expenses are tied to your passive income. I'll get into those topics, so don't worry. But just to demonstrate, so for example, let's say your monthly expenses, you expect them to be 70,000. Okay, so what this diagram shows, it shows you automatically, it will color it in green when you've exceeded that limit. So for example, for you to earn the first instance you can earn monthly passive income without doing anything with a money market fund would be somebody who contributes 20,000 per month, and they started with they are contributing 20,000 per month. But let me keep this consistent to 2,500. Let's see. Or let me change it a little bit to make it interesting. So 15,000, which is somebody in the middle class range, somebody who's working around maybe in their 30s. They should be able to find savings of this amount per month. So, and they're asking themselves, when can I become financially free? Sorry, I have a cold. So that my monthly expenses of 70,000 are covered by my interest from my money market fund. So, based on that scenario, it means that the first instance would be 15,000 combined with a contribution of 20,000. After 13 years, your money market fund on a monthly basis will be giving you 83,000, so which covers your expenses. Okay, and obviously you can increase this. So for example, if you increase your contribution to 20,000, then you'll get there sooner. So let's do 20,000. 200, 20,000. Okay, so 20,000, the contributions, I'm just assuming 1,000 up to 9,000. Then after that, it's increments of 5,000. So this person, for them to get to 70,000, now they are doing it by contributing. Well, we are still at the same range with the person contributing 15,000, because we already exceeded the 70. But you can see that they get a higher income uh, per month compared to the person who had 15,000 to start with. So that's one of the most important elements of this template. I did explain that this part of the template shows you when you get to your first million. So, and for you to see that, the beauty of this is maybe you start with your 2,500. Then after that, I'll increase by increments of 5,000. Okay. Yeah. So the way to use this part of the template is to say, if I have 0, then I will never get to a million, even after 45 years. If I have 5,000, I start with 5,000 and I invest 1,000, I will get to a million after 30 years, 1.5 million to be specific. if I use 2,000, it means I'll get to there 10 years before, so at 20. So you can see the impact of just a 5,000 difference. And that goes down to these limits. So somebody who's doing 40,000 and they started with 80,000 will have 1.1 million within 2 years. So what I find useful about this is it helps you plan out. So if you're building a house and you know, or maybe you're buying a house and you know that house will cost you 7.5 million, you don't want to take risk, you don't want to lose your capital, so you decide to put the money in a money market fund. And then it means for you to build your house, you'd have to save for 11 years, and you'd need to save 35,000 per month, uh, having started with 75,000. You can get to that 75 million in other instances by one, maybe increasing the amount of the number of years. So for example, if you increase it by 2 years, then it means you can, after 13 years, you can do the same thing with 30,000 of contributions and 70,000. If you want it to be more affordable, so for example, 10,000 and 50,000, then you just need to search where your 7 million is, and it looks like it will be after 20 years. So that's how you play around with this. But as I said, if you open a money market fund or a unit trust account with my signed forms, then you get a free PDF report based on the amounts that you'd wish to contribute per month and your initial investment, and various scenarios for you. Yeah, and you also need to be a YouTube subscriber, so I put those two criterias there. But I did say, and I mean it, I know it's very valuable. Somebody else would sell this kind of information, consulting. Consult me to tell you how much you'll earn after certain, if you invest certain amounts, at a rate of Z, for example. But yeah, if 1,000 people and these people teach another 1,000 people the lessons that I'll be imparting, then that's how we change society. So yeah, if I wake up one day and see 1,000 subscribers on YouTube, I'll just share this template on my website. I'll make it editable so that you can play around with it and play around with the scenarios and get to your decision. So let me know if this is helpful, if you want me to play out other scenarios, if you have questions about how compounding works, and I'll do another video. But what I'll do also is I will accompany this with an article on my website where I clearly enumerate my thoughts. As I said with my videos, it's for free, so I don't do special editing, etc. I just speak as it comes to my mind. So great. I think see you in the next video. Bye bye.